This is how the Federal Reserve lowering the interest rate affects you. First of all, what rates are we talking about? The Federal Reserve controls the rate that banks charge each other overnight to borrow money from each other, also known as the federal funds rate. So if the money gets more expensive, the banks are usually going to pass that cost along to you, and vice versa. If it gets cheaper, then you see lower rates on certain things. So what does this have direct impact on? Things like an auto loan. So if you're shopping for a new car, you might see a reduction in interest rates from the prior week. If you have a line of credit on your house, or if you have a credit card, you will see lower interest rates on those. However, this doesn't impact long-term mortgage rates, which are typically tied to the 10-year Treasury yield. So that's a completely different ballgame. So also, if you have money in a high yield savings account, you'll notice how that just went down. You know, if it was paying 4%, it probably went down to about 3.25, 3.8, right? So there's a lot of things that get impacted by the changes in the federal funds rate. So you need to be aware of those because they impact you whether you are a borrower or you are a saver.